All right, welcome to The Explainer. Today we're going to unpack one of Wall Street's most powerful and, let's be honest, most controversial strategies out there: deep value.
This quote just nails it, right? Deep value is investment triumph disguised as business disaster. It's the whole idea in a nutshell. This is a strategy that has built legendary fortunes by finding absolute gold where everyone, and I mean everyone else, just sees garbage.
Now, what's really fascinating is that this isn't some static, dusty old idea. It's a story of evolution. We're going to trace how this philosophy went from, patiently waiting for value to pop up to actively, and I mean aggressively, forcing it out. And we'll do it all through the eyes of three icons who completely changed the game.
So, where do we start? Well, our story has to begin with the godfather of value investing himself, Benjamin Graham. This guy literally wrote the book on it. He created the very first map for finding buried treasure in the stock market.
Graham's core idea was, it was brilliantly simple. He called it cigar butt investing. Think about it. You're walking down the street, you find a discarded cigar with just one good puff left in it. It's free. That was his approach of stocks. Find a company trading for so cheap, we're talking less than its physical assets are worth, that you can buy it, get that one last puff of profit, and then just toss it. Who cares if the business itself was a total mess?
But, and this is a huge but, Graham's most famous student, a young guy named Warren Buffett, he realized there was a massive flaw in this thinking. You see, when you buy a mediocre business, even if it's super cheap, time is actually your enemy. It's working against you.
And that realization? Well, it leads us straight to our second innovator. Buffett completely sparked a revolution. He shifted the entire focus away from digging around for those cheap, nasty cigar butts, and instead, he started searching for truly wonderful businesses, the kind of companies you'd be happy to hold on to forever.
And this chart really lays out the difference, doesn't it? For Graham, it was a numbers game, pure and simple. It was all quantitative. But Buffett, he brought in a qualitative focus. He started asking totally different questions, like, how good is this business really? Does it have what he called an economic moat? A durable advantage that protects it from competitors. Things like a brand people love, or products that are just a huge pain to switch away from.
His purchase of See's Candies back in '72 is the perfect case study. He paid a price that would have made his old teacher, Ben Graham, just choke on his coffee. It was way more than its physical assets were worth. So why'd he do it? Because Buffett understood the real value wasn't in the chocolate-making machines, it was in the brand, that intangible, powerful loyalty that See's commanded from its customers.
Okay, so Buffett was willing to buy a great business and then, patiently wait for it to grow. But our third character, Carl Icahn, he had a totally different mindset. He looked at these undervalued companies and asked a much more aggressive question. Why on earth would I wait for the market to figure this out? Why not just force the value out myself?
See, for Icahn, the problem often wasn't the business itself. The assets were fine. The problem, he believed, was lazy or self-serving management. He saw executives getting rich while the company's true value for shareholders just sat there, locked away in a vault. So what did he do? He decided he was going to be the locksmith. And he went after companies like the stove maker Tappan. Just look at these numbers. Over 5 years, the company lost more than $3 million. But at the same time, its top two execs paid themselves over $1 million. For Icahn, this was a giant, flashing red light, a clear sign that the people running the company were not looking out for the actual owners.
So this led Icahn to create what you could call the activist playbook, and man, was it effective. Step 1, quietly buy up a big chunk of the company. Step 2, go to management and demand changes. And if they said no, Step 3, launch a proxy fight to get himself and his allies on the board. Once he was inside, it was game over. He'd push to sell the whole company to the highest bidder and unlock that value right now.
And believe me, this strategy worked. How well did it work? Well, it was so effective that after Icahn forced the sale of Tappan, the CEO he just battled, Dick Tappan, was so impressed that he actually invested in Icahn's next fund. You really can't make this stuff up. Now, Icahn's playbook, it didn't just stay in the 80s. Oh no, it grew into a major force in today's market. Now, you see activists using these same tactics to target some of the biggest, most successful companies on the planet.
And you want a perfect example? Let's talk about Apple back in 2013. Activists, including our old friend Carl Icahn, looked at Apple's books and they saw this one jaw-dropping number,
137 times billion dollars. That's how much cash the company was just sitting on, earning practically zero interest.
I mean, that raises a pretty massive question, right? What do you do with a pile of cash that's bigger than the entire value of most companies? To the activists, letting that money just sit there was criminal. It was like locking it in a vault where it slowly rotted away. They argued it was actively destroying value for the people who actually own the company, the shareholders.
So what did they do? They launched a very loud, very public campaign. Their demand was simple. Apple needed to return all that dead money to its investors, do huge stock buybacks, issue special dividends, whatever it takes. Their whole goal was to get that mountain of capital out of the vault and back into the hands of its owners.
And guess what? The pressure campaign totally worked. Apple eventually announced it was going to return $130 billion to its shareholders. And the result for the stock? It absolutely soared, up 56% in less than a year. It was a massive win that proved just how powerful this modern form of activism had become. So as we bring this all together, you can really see the evolution of this one big idea. It started with Benjamin Graham, just patiently waiting for value. Then it evolved with Warren Buffett, who focused on buying wonderful businesses for the long haul. And then it got supercharged by Carl Icahn, who said, forget waiting, let's force the value out now. And today, that same playbook is being used on the world's biggest companies.
And all this leaves us with one final and pretty crucial question to chew on. Are these activists heroes? Are they fighting for the little guy, the everyday shareholder, against lazy management? Or are they just modern-day corporate raiders, dressed up in a fancy suit, only caring about a quick buck? The truth, just like the strategy itself, is probably somewhere in the middle.